The Bear Roar Special Edition series, Bandwidth, serves as a platform to celebrate the people and stories of Dan's book, Bandwidth, the untold story of ambition, deception, and innovation that shaped the internet age and the dot-com boom. The story covers the epic journey of the creation of the internet backbones, the building of the early competitive fiber networks in the 1990s, the bandwidth boom, bust, and resurrection, ending in 2020 when Dan's company, Zayo, was sold. The book is available for pre-order on Amazon and Barnes & Noble with a February 2025 release date. Head to dan-caruso.com/book for more details. In this episode of The Bear Roars, Dan reunites with Gillis Cashman, managing partner at MC Partners, a private equity firm that specializes in investing in growth-oriented, lower middle market companies across sectors like technology, media, and communications. Gillis was a key collaborator to Dan during the turnaround of ICG and the creation of Zayo. From buying billions in assets for pennies on the dollar to building a telecom powerhouse, Gillis and Dan share untold stories from the front lines of transforming the industry. They dive into the future of AI-driven networks, quantum technology, and what it takes to spot opportunity in chaos. Let's poke the bear to kick off the conversation.
All right, Gillis Cashman. I'm looking forward to this one.
See you, man.
Yeah, great seeing you, and look forward to seeing you live before too long. I got to get myself out to the East Coast this year and stop by Boston area and head on down. Ever since COVID, it seems like the East Coast is not a direction I've been headed.
Yeah.
But we'll figure that out.
After 20 plus years of building across the street, we finally relocated. So I'll show you.
Oh, did you?
Yeah.
All right.
Of course, we signed.
So, Gillis, I'm going to throw a name out there, and let's start by talking about this name, Peter Claudy. So tell us about Peter Claudy.
Yeah. Peter was my mentor. So I joined the firm, 25 years ago. So I was a young 24-year-old. And he really took me under his wing, and was just, super smart guy. He actually, I'm not sure if you even know the story, but he actually introduced me to my now wife.
I think I had heard that years ago, but I had forgotten that.
He was neighbors with one of her partners, and the two of them got us together. So we actually both went to Duke, but didn't know each other at Duke. But so he was awesome. He really taught me a lot. He worked when I first came in. I worked on the CLEX and a lot of the early fiber investments, and so worked for him on a lot of those deals. And just a super smart investor, and just a great all around individual. And it was unfortunately, as you mentioned, he passed away in 2006 from colon cancer, and it just was it was tough. It was tough because he was my mentor and a great guy, and we had a lot of fun working with you on ICG together. I remember that phone call we got, or he got, when we were actually trying to. We actually been looking at another deal where we needed a CEO, and ended up walking away from that deal because we couldn't find the right person. And like literally a month later, got introduced to you, and the rest is history. But
yeah, and so I didn't know Peter very long, but he had certainly a very influential impact on my career. And really, he was one of those guys where it was more than just an impact on career. You just kind of admired him for his intellect, for his boldness, bluntness. He would get right to the point. And he was one of those guys who, when he had something to say, you should be paying attention because it usually was very relevant to whatever the topic was. So my first encounter with him was, as you said, when you guys, MC Ventures, was partnering with Columbia Capital, looking at an opportunity and searching for a CEO. And I had just recently left Level 3 Communications, and that was really the beginning of my journey as a CEO. Do you recall when you and I first met? Is there any recollection there?
Yeah, it was the spring of 2004. So when ICG, I think right after you had talked to Peter, because we were engaged in a couple projects. I think for about a year we looked at, actually probably it was 2003. A year we looked at a different bunch of like voice over IP businesses together, and a number of those deals, and then the ICG deal came up in 2004. But yeah,
we ended up stumbling into a great one. The situation in ICG. So ICG was a Colorado company that had a storied past in the, starting in the early days of competitive telecom, really starting out as a CLEC and then building fiber networks, maybe even a prehistory as a satellite company and satellite receiver, if I remember that correctly. But by the time we started to collaborate around it, it was getting ready to go into a second bankruptcy and not easing its way in that bankruptcy, but going in, in a very desperate situation. Company that was running out of money. They had 30 million left on their balance sheet. By their math, they were burning $8 million a month. So if you do the math, they're going to be out of money in 3 to 4 months. And so we stepped in, bought out the equity, took it private, and everything turned out really well. And maybe we'll get into some of those stories later on in the conversation. But let's jump around a little bit. So let's skip the next 20 plus years and jump into Gillis Cashman today. So tell us about you're still MC Ventures. You've risen up quite a bit there. You're in a leadership position. Tell us about what's going on at MC Ventures, both now and as you look forward in time.
Yeah, so we've been a very sector-focused fund. We've been doing comm services from before my time. We spun out of TA in '86, and so and we're lower middle market, and so we like our sector and our focus area. We like to deal with founders, and really we think of ourselves as company builders. And so it's really finding assets, not so much like ICG, but assets that are in some form of repositioning, and really bring teams in or resources that could be certain executives, it could be entire teams, to really accelerate and improve those businesses. And we do a lot of M&A with our companies. I think the last 2 funds we had 8 deals in Fund 7, got probably 10 or 12 in Fund 8, and those companies have done probably like over 60 acquisitions. So a lot of the companies, a couple per fund will get very large. Typically our sweet spot is getting into businesses that are anywhere from 10 to 30 of revenue. They can be higher times, but then typically selling when we grow them to 100+ million of revenue.
Well, let's talk about a couple big trends that are, one happening in real time, one that's going to be happening in a few years from now, both of which should have significant impacts on communications networks. The first one being none other than AI. And I want to talk both about AI and the impact it's having right now on fiber networks, kind of what insights you might have and how you're thinking about it. But then I want to almost brainstorm a little bit around a conversation I had recently about what might happen relative to AI as it impacts kind of communications infrastructure and especially fiber networks. So let's start with, in kind of present time, we've seen as a very visible example, we've seen Lumen stock price jump up from hovering around $1 or even less than $1 a share for quite some time to almost overnight, going from $1 to $8, now back to about $6 a share. So up 600 to 700% in a 1 week or so period of time, tied to an AI announcement. When you look at that specific event and the effect on fiber networks in general as it relates to AI, how are you making sense of all this?
Yeah, I think the question is, a ton of capital is being spent right now. And the question that we have, is really how much of this is building purpose-built networks, versus a much longer term trend. The demand is off the charts. And I think when you think about the campuses that are being built, these are billion plus campuses in terms of these hyperscale facilities where, building a $50 to $100 million network connection into that, is kind of a rounding error, right? So there's a lot of demand for connectivity. You're seeing these facilities get put in places where they're more focused on where the available power is versus, connectivity. And so that connectivity needs to be built, and they're willing to fund that. So I think that's gonna go on for a while. I think the question is just, when that's built, then what? Because I think unlike, given where some of these networks are, unlike what we saw with Zayo, where you were funding, fiber to the tower, and you could resell those networks for commercial. It's a question of, are these networks so purpose built that they can then be sold, for enterprise and other customer segments.
And that's where I want to brainstorm a little bit. So right now, when we think of Gen AI, there's gigantic amounts of processing taking place in these gigantic data centers. That's where the Gen AI is happening. That's where they're looking at huge data sets and trying to make sense of them and producing kind of outcomes that we're experiencing with the ChatGPT and Perplexity and the many other platforms. So the question as you look forward in time is, does Gen AI produce, I shouldn't say Gen AI, does this, Gen AI trend, does it progress to the point where there's a more distributed level of activities that involve the making sense of these huge data sets? Does that happen instead of only at these very large data centers that sit near, high utility centers, to the point where it's happening, I'll say at the edge, maybe not at the very edge, but in a much more distributed fashion? Will there become a point in time where Gen AI has a distribution, and hence with that becomes a whole new wave of activity around the consumption of fiber? I'll focus on fiber, the consumption of fiber on a much more distributed basis. I haven't heard anyone talk about that, but I
think it's interesting. I heard, we've done some work on this. Obviously, as you enter the inference phase here, that is a far more distributed, architecture, where you're going to need, smaller facilities closer, to the edge, where all that intelligence doesn't need to be in the, at that edge location. That, I think, is, from what we've been hearing, anywhere from a year to 3 years away. I think no one's really kind of I think when you listen to some of what CoreWeave's saying, they're starting to see some of that, but we haven't seen any evidence of that. But I think what's intriguing about on the fiber side looking forward is really thinking about the demand for sort of these AI exchanges, where you've got, basically tapping into all the different models. And so it's not using one model, but it's tapping into other models, and where there's also models from a compliance or governance perspective that need to be closer or even on-prem for some of those that also can tap in. So that's where, and I don't know what that looks like. It's years away, but that's where you could see just a massive surge in data. When you think about just what that looks like, and it's, machines talking to machines, just the speed, the latency requirements, could make a, pretty interesting case for, the next sort of upgrade of fiber.
Yeah, kind of building on the on-prem notion, the desire to want to put your own information into a Gen AI database so that you can work with your own information to do the things that AI does, but you don't want your information being put into a database that is shared by the broader set of Gen AI models. To some degree, you could do that virtually, right? You could do that with somewhat of a trust factor. The data center might still be elsewhere. It still might be in some cloud environment, but the notion is the data you're putting in there is protected from others being able to use that information for their Gen AI purposes. But then there's the notion of, well, is that enough, or is the data that proprietary that you want to physically be in your facility, whether that's wherever your locations currently are, or a data center that that physically belongs to you, in which case that would start to lead to a much more distributed model.
Yeah, I think it's going to depend on the industries and the compliance requirements. I mean, you can see in the financial services industry, just there being a lot of sensitivity around that data being, in central locations versus
and
not.
Healthcare is another prime example.
Yep.
Yeah. So then the next one, then we're going to get back to some old bandwidth stories. Next one I'm going to talk about is quantum, because quantum, when people talk about quantum, they talk about quantum computing, which is a big deal. Whether it's 3 years from now or 10 years from now, at some point in time, it's going to go through a similar hockey stick curve that AI has gone through in the last two years. So, there's going to be a lot going on behind the scenes for a period of time, has been and will continue to be. But then there's going to be a crossing the chasm event that is in the foreseeable future, but hard to predict exactly when. But there's another two big aspects of quantum that one is usually termed as quantum sensing. So you could think of it as something similar to Internet of Things, but with quantum devices that play a role in everything from how mobile networks work, quantum radio frequency, to how timing networks work. So advanced precision timekeeping using distributed quantum technology, to how positioning systems work, quantum positioning systems. So you think of these quantum devices that are scattered around, sensors doing all the things that sensors do, but at a whole different scale. And then you combine that with the third category, which is referred to as quantum communications or quantum networking. And usually when people talk about quantum communications, they're talking about the security aspect, which we won't get into right now. But by my way of thinking, and this is going to take a number of years to develop, you can liken that to the early days of the internet. In the early days of the internet, when the internet started to come onto the scene, what were the communications networks? Well, they were the telephone networks. They were dial-up phones. They were SONET. They were the same technologies that we use to carry voice. We would just packetize the internet onto the traditional networks that were designed around lots of phone calls. But over time, that progressed to a point where internet traffic started to be traverse networks more efficiently with networks designed around the internet. They're Ethernet-based networks, wavelength-based networks, so much more raw, internet talking to internet devices. I think the same thing will happen with quantum, whereas the networks will move from today's networks into networks that are quantum. Like, why would one quantum device want to talk to another quantum device and have to convert itself to the conventional world? It would rather talk in native quantum. So, as AI develops and as quantum develops, I mean, the waves of what will happen with communication networks will change dramatically. So, good news for the young partners, young analysts in your firm, Gillis. They're going to have something to work on 5, 10, 15 years from now.
I wanted to ask you, because I have seen that, because we have started to look at the early applications of quantum and the impact on networks. And I saw some utility down the Southeast had built a quantum, enabled fiber network. And again, I just way above my, understanding in terms of technology, but like the polarization of existing fiber networks, doesn't allow for good communication for quantum applications, just because they're very sensitive. And so it was almost inferring that, much like you think about, the original business plan for level 3 and why this networks had to be rebuilt, there's almost this whole upgrade cycle of actually building these fiber networks that are quantum enabled. And that would be very interesting, because that would sort of lend itself to a massive upgrade cycle of fiber networks. If that, and again, it's very, very early and we're starting to do our work on it, but just sort of the fact that existing fiber networks may not be, quantum enabled, I guess, or the ability to kind of support quantum applications, that's where there could be a real opportunity.
Yeah, I might substitute the word enabled with the word optimized. They might not be quantum optimized. The initial quantum networks will use existing fiber, will kind of work within the constraints of fiber networks that already exist. Constraints mean things like where are there regeneration or amplification facilities. So they'll be designed to work on those, because you're not going to, as step one, spend billions of dollars and rebuild networks or invent new fibers. But I think in parallel with that, the question of, okay, in low volume, it doesn't really matter, but as you get to higher volume, is there a different type of fiber that is more conducive to quantum devices staying in the quantum realm? And the answer is almost certainly yes. And then, how are those, the equipment that gets put on those networks, how are they spaced? Where do they exist? What are their needs? That will start to come into play. I think that's, 5 to 10 years from now, not, 3 or 4 years from now. But there is one specific idea that would probably be worth kicking around offline, because I think there might be a near-term use case that has to do with a very specific application that that needs kind of a service provider, a network-based service provider, to play a significant role in. And maybe we'll talk about that offline. I know the product and the technology and the customers, but right now it's people developing kind of the technology, and you're almost assuming that the customer is going to run their own network. But in reality, it probably works best when there's lots of customers using the same network in order to accomplish it. And that starts to, by my way of thinking, sound like, the equivalent of an early internet service provider. Yeah. So we'll talk about that offline, because that could be an interesting opportunity to grapple around with. So, but the good news is with and I'm still an investor in Zayo, and I think Zayo's like Lumen is benefiting from some of these concentrated trends around AI. Concentrated meaning lots of fiber to very special locations, but the distribution of AI may produce a much bigger wave of opportunity for the fiber providers. And then if you layer on that what might happen with quantum, that could be a whole nother wave. So a lot of reasons to be optimistic about the future from a networking standpoint. But let's go back in time. So we do ICG. ICG was from an investor and a executive team standpoint, it was a very positive outcome. But the positive outcome was achieved by taking a very distressed company, a company that was going through its second bankruptcy in a very volatile time. We were still in the throes of what happens after the meltdown. How does the industry kind of get itself resituated? And in that case, in the case of ICG, we decided to turn down pieces of the business that really weren't working and didn't have a viable future, in our opinion. We sold off some of the pieces. We kept the core and then sold the core off, all in a pretty short period of time. So financially fulfilling, but we broke apart a company. We didn't build something. But then we set our sights together to go build something. And given the positive experience that we had, we being the management team and MC Ventures and our other partner, Columbia Capital, we decided to collaborate again and launch what became Zayo Communications. And one of my favorite early stories in Zayo Communication was the time you and I met in Washington, D.C. to go meet Bill Boyle. How much memory do you have of that trip? Because to me, it's always one of my favorites.
Yeah, it was like in Arlington, Virginia, and it almost felt like he was like in an apartment complex. I mean, it was like there was no reception. It was a card table we sat at. That was a interesting meeting.
Yeah, so in the early days of Zayo, well, really throughout most of Zayo's history, I mean, the thesis was there are all these like fiber properties scattered around, and they all had some kind of unique and often quirky history. They came out of, I called them fiber orphans, meaning the property was orphaned. It used to be part of a bigger company. It used to be, it was a business plan that got funded and got started right before the crash. It was, in a utility, and the utility wanted to get rid of it. They all had their own unique stories. And so we'd go around and basically go on a hunting expeditions. We'd reach out to the CEOs or the investors, find out the status of the businesses, kind of what their intent was. And we had kind of the investment thesis that, that these businesses are in temporary homes. They're not in their permanent forms. Someone got a hold of the property. What we found out in most cases was doing the right things with their properties. The properties were being run well, subscale, but their financials were strong. They were growing, but they were under the radar of the investment community because the investment community was still reeling from what happened in the telecom meltdown. So one of the visits we went on was in the DC area in Virginia to meet with Bill Boyle of a company called Watergate Fibergate. And he had, so we went up to go meet with them. And, my memory was it was a strip mall, like a 2-story strip mall. We get there, we're looking around, trying to figure out what office this is, walk up some steps. It wasn't well marked. We're knocking on a door, ringing the doorbell, no one's answering. And then, up off the street comes Bill Boyle saying, there's only 4 of us at the company. And I'm surprised you even came out here to visit me. What do you want to talk about? And really, turned out, that was our first meeting, but got to know him well over the years. Eventually, much later on, unfortunately, bought his company for a much higher price. But he was a perfect example of a clever entrepreneur who got his hands on some really interesting fiber assets and then worked, with originally the branches of the federal government to further build out the network where they're funding it. And he's ending up with more and more fiber in the very important region of Washington, D.C. But it was fun watching his journey and being part of that to some degree as he took that business that we probably could have bought for $30 million. He turned down our $21 million offer. He countered with 28, and I didn't, for whatever stupid reason, I didn't jump on that. And we ended up buying it years later for over $100 million. But he did a really good job building out a great business.
Yeah.
But it was a sign of the times. I mean, there was a lot of that going on.
Yeah. I think what was interesting about the Zayo experience was, obviously we had just come out of ICG, right, where we bought $3 billion worth of assets for $8 million, right? And
well, tell them how we bought it for $8 million. What?
Yeah, so that's another great Peter story. So I remember on that conference call with you, where Peter just was a very good negotiator. Did his work. I remember we hired that one. Was it Jamie Sprayregan? I remember it was back then his bill rates were off the charts. And so every time, he'd be on a call, we'd be like, all right, thanks, Jamie. You can drop off the call. But he's a great, amazing lawyer that structured a great deal. And we, I remember you had said something like, guys, I really think this business is worth $50 million. And Peter's like, I think we can buy this for $8 million. And I remember your quote. You said, well, if that's the case, I'm going to make you a blank ton of money. But yeah, so we bought it for that. But I think what was interesting, though, is, and we had obviously outside of ICG, we had done a lot with our other companies where we were buying these businesses. We bought the Dominion Telecom Network, which had $1.3 billion invested in it. We bought it for, I think it was $1 million. The next closest bid was -40. So it was a crazy time to be buying stuff. And then fast forward to 2006, we're starting to talk about, if you remember, PPL was the first deal we did where it was, we were talking about 6 to 7 times EBITDA. And I remember the discussions around my firm, like, hey, gee, listen, what is this? Is this the right multiple? This, 6 to 7 times. We just bought ICG for absolutely nothing. Why does this make sense? And having those kind of debates. And I think what was interesting in that period of time, to remember, there's been so much network that got built out way ahead of demand, right? Mm-hmm. And all the long haul networks have been built, but the local networks never got built. Like the music stopped before the local networks could really get built. But at the same time, over that period, all that disruption, where Verizon, all these companies are going into WorldCom, all these companies are going into bankruptcy. No one's investing in capital. Everyone is cutting costs, and so no one's investing in the network. You had this massive increase in computing power that just got where you saw demand get way ahead of the network. And that's really what was interesting about Zayo, is you had these small owner-operated, founder-owned businesses that they just didn't have the balance sheets to make these long-term investments. So, when we were talking about fiber to the tower, 20-year deal, 5-year payback on capital or 4-year payback on capital, they couldn't sign those deals because they didn't have the capital to invest, that long. And so that was what was, interesting about the strategy, was basically giving these companies the ability to invest in their network and sign just amazing, from an IR perspective, amazing deals. But again, it was a fun ride. It was definitely a fun ride.
And part of it was certainly driven by the capital constraints of a lot of the companies, that they just didn't have the capital to invest in longer term deals. But there also was a skepticism in investing in those types of deals. I mean, how many companies would we see, including, one of the best run companies in, called the 2010 to 2014 era was AboveNet, formerly MFN, and they had a philosophy very similar to TW Telecom, who was also doing well in those years, and many others, which is, if there's not a 6-month cash on cash payback, we don't want to do it.
Right.
So if you think about it, if you're working with a customer who gives you a contract, which is what you're alluding to, that's very long-term in nature, and in many cases they're upfronting some of the capital to build out a network, you're getting 20, 30 years worth of value in the asset, an EBITDA contribution that, if you put any multiple against it, would justify, a payback period of a lot more than 6 months, and then the opportunity to resell into that asset. Yet those who were out there in that time frame were so either capital constrained and usually it was and not ready to make any type of, even, I wouldn't even call those speculative investments, because it wasn't like you were speculating that you would go and add more revenue onto the capital you're deploying. The only speculation was that the contract would play through, which is in those, when the counterparties had names like Google and Verizon Wireless, that was a pretty safe bet. But that's not, the industry wasn't taking those deals. So the opportunity that we, I think, figured out, not us alone, but we were certainly at the forefront of it, was that there's a lot of opportunities for taking. You could buy these properties at relatively, I'll say fair EBITDA multiples. And what I mean by that is, there's a perception that in the Zayo era, we were buying properties for extraordinarily low EBITDA multiples. But if you look back, the EBITDA multiples at the time we bought these properties averaged around 9 times EBITDA, maybe 10 times. So maybe low relative to 12 times, but certainly we weren't buying them at 3 or 4 times, like if it was a couple of years prior to that. So from an EBITDA multiple standpoint, it looked like the sellers were selling at a good time relative to a handful of years earlier. Yet when we were looking at these properties, it was easy for us to see how, if you buy something at 8 or 9 times EBITDA, it would quickly, through growth and later through synergy, you'd go from about 8 or 9 times EBITDA to 4 to 5 times really quick. And you're using about 4 times debt to buy the properties, which means that delta all went into the equity, value creation bucket. So, and it lasted. In hindsight, it didn't feel like at the time, but right after we started Zayo, that's when the Great Recession started. That's when the financial crisis hit. Do you have any memories from we're sitting there, we just started Zayo, we just bought a few companies, we're feeling pretty good about what we're doing, and then boom, the financial crisis, shuts everything down seemingly.
Yeah, no, I do remember, because I remember, I think this was before we had hired Ken, trying to raise that first bank facility. It was I think it's probably one of the more painful bank facilities I've ever been involved in trying to raise. And it was
because we didn't have the right, we needed Ken.
yeah. But it was just like, I think we were talking about like 3 or 4 times leverage on a company that had long-term contracts and stable recurring revenue. So, but I think it was also a time where there was we did a lot, right? We bought a lot of companies because there was a lot of distress out there. I think what was raised capital from the Charles Bank guys to do the FiberNet acquisition. So I think we were, I think knowing exactly what we wanted to do and what the play was going in, we were able to really move quickly, and get things done. Which at any time there's that kind of distress, we saw it in the 0102 timeframe. Having that focus and that the ability to kind of identify those trends up front, we're able to capitalize on that.
Yeah, because Mike Che from Charles Bank, he led the Series B, and he led it in the environment in which the financial crisis had reared its full ugly head. So at that point, it was, I think, 2009. So we kind of knew the environment we were in. And his thesis, alongside ours, was what a great window of opportunity to buy up fiber assets because they're going to get, even cheaper. Now, in hindsight, they didn't really get cheaper as we expected they would. We've still had to buy them, if anything, at slightly higher multiples than, say, 2007 timeframe. But there weren't really other buyers of those properties to speak of. It's just the sellers were doing well. I mean, they were running their properties well. They were not burning cash at that point. They tended to be growing as businesses, so these weren't fire sales. The sellers didn't feel like, boy, I have to sell this asset. It's, a financial crisis, and I'll take a lot less than I would have taken a year or two earlier. That didn't quite play out, but what did play out is we could buy assets because in an environment where, as long as we could hit the price that the seller was looking for, they were willing sellers, and there weren't competitive processes in that time frame. So we were able to pick up a whole string of interesting assets.
That was one we were able to buy pretty cheap because that was one when we closed that deal. We got that one done. I remember that one.
FiberNet, the New York public company. That's what you're thinking of.
Yeah.
Yeah, but even that was, probably 10, 11 times EBITDA, which in hindsight, you would say it's cheap, but at the time, when I was researching the book, the bandwidth book, I was kind of looking through stuff, and there was kind of a really interesting kind of set of comments. You remember Telecom Ramblings? It's still around today, but that blog was introduced about the time Zayo was launched, and Dave Rusin from AFS was commenting on our acquisition of FiberNet. So that was a public company, so we signed, and then it had to go through a go shop period before we can close it. So there was a period of time where other bidders could have emerged, and he was making the case publicly through the blog post that the reason other bidders weren't emerging is that Zayo was overpaying for the asset. The asset could be easily replicated, and the amount we were paying was ridiculously high. And it turned, when we were looking at it, we're like, man, this is like, whatever the EBITDA multiple was, to say it was 11 times. We looked and said the post-public company integrated with us will immediately be 6 times EBITDA. So the post-synergized multiple within months after we would own it, get rid of all the public kind of costs, get rid of, it was basically a small set of assets that you didn't need that many extra people to operate their assets if it was in the construct of Zayo. So it was very, very EBITDA accretive to us the day we got it. But the EBITDA we paid, would look like, a higher EBITDA.
Mm-hmm.
But those are the kind of deals we were able to do in those days.
Yeah. Yeah, AFS was another one. I remember having that discussion at the board. We're talking about, I think we bought that, for 14 or 15 times?
Yeah.
And, but I think the day we closed, it was more like 7. I mean, there was so much there. So
and that one was interesting because there were a lot of extraordinarily underutilized assets in really interesting growing markets. So that one.
I forgot about the questions that Dave planted in your employee meeting.
That was funny.
That was
one of the more funny stories. I was, going back and forth whether to share that, but it's a sign of the times. A lot of what's interesting about the whole experience is all the people who, including Dave, who gave their blood, sweat, and tears to to build the industry early, to try to navigate through the difficult cycles, trying to kind of build something kind of in the post meltdown era. And there were so many teams of people who did so much to kind of create the industry that the entire, I don't think it's an overstatement to say the entire world has benefit from to this day. So I wanted to share those stories and share those people and how it's all interconnected together. And hopefully there's a lot of learnings there. So let's talk
Yeah.
about some of the other fiber ventures that MC Ventures was involved with. You guys were integral to what became Light Tower, a huge success story, and in some ways, kind of for a period of time there, Zayo's rival when it came to consolidation plays. Somewhere in the called 2000, maybe 2012 to 2016 timeframe, they were often the company we were going against in terms of acquiring certain properties or competing for some of the bigger commercial contracts. So that's one. You mentioned Dominion. That's one. Talk about some of these other ones and the journeys that you guys went through and in that era.
So it started with before my time, '94. Brooks Fiber. That was Jim's deal. We founded Brooks Fiber, with the Providence guys and a number of other investors, and then
including Centennial Ventures, right here in.
Right. Yep. There was a bunch of telecom investors in that one.
By the way, we're launching Steve Halstead. He did a podcast with me. We're launching that. By the time people see this one, it would have already been launched. But Steve's considered the grandfather of venture investing here in Colorado. So he shared with us the stories from really before there was venture in Colorado and how that started and how it was related to cable TV heritage and then wireless networks, fiber networks, including Brooks. So fascinating podcast.
Yeah. And I think so. After Brooks, a lot of the CLECs that we launched were all fiber based. So Foam Michigan was Brad's first CLEC. That was all fiber based. Ovation, even FDN, and then Cavalier was one that ended up being probably one of the larger fiber networks that was kind of started off in Richmond, went to Northern Virginia, but then as you mentioned, when the market crashed. We really capitalized on a lot of that distress. So Cavalier bought, the connective utility network, which is I think they had spent like close to $300 million across Delaware and in Maryland. Bought that for, gosh, I think it was like, I don't even think we paid cash for it. We basically sold an IRU back to them. So it was sub 10 million was the consideration. But then the Dominion one was very interesting. That's, as I mentioned earlier, that was one where 1.3 billion had been invested. And we ended up buying that for $1 million, where I think 100,000 was the equity, and then 900,000 was we bought all the unsecured liabilities because we knew we had to take it through bankruptcy to cleanse a lot of the leases. But that's when I mentioned where level 3 was negative 40 million. I think was what I heard was the next closest bid. But I mean,
Dominion was the power utility, so this was their fiber business. Is that right?
Funny, they had we bought that in 2003. It was strange because it was almost like the internet meltdown happened in 2001, and they were continuing to build. It was almost they built this long haul route from DC to Chicago and gold plated it. So it was what was interesting about that time was these networks were really viewed more as liabilities. And so, you ask why would Dominion kind of unload this for $1 million if they spent 1.3 billion investing in it? And really what was going on, it was impacting their credit ratings at the larger utility. And so it actually was accretive for them just to get this off their books versus, trying to maximize value. So that was a very interesting time, is just how.
So take us through that. You bought Dominion for negligible amount of money. What did you do with it? You said you took it through bankruptcy. Was it burning cash at the time? How did you stabilize it? And then what eventually happened to it?
So it was burning about $2 million of cash a year. So not a lot, but there were very strategic networks in the Mid-Atlantic that Cavalier needed. And then there was also ones up in the Northeast that were very dense networks. They had a bunch of routes going down the Southeast, which were basically IRUs from level 3 and others. And those were networks we just didn't need. And so we wanted to just basically, get rid of those. That's actually where I met Don for the first time because he was on the credit committee.
Don Gibbs?
Yeah, Don Gibbs, level 3. So we had to take it into bankruptcy to basically reject those leases. The funny story there is I got put on as president of the Atlantic. It was the Atlantic is how we called the entity that bought the Dominion. And so I ended up getting deposed on that whole transaction, which was definitely an interesting experience. But basically, I mean, what we had done was the right way to structure the deal. I mean, we were the only ones, as the judge said, we were the only ones to step up when no one else would. And so basically,
let me take a pause for a second there, because I want to, and tell me if I heard this wrong, but you bought, so they spent $1.3 billion. Now, a lot of that was probably wasted, but a good amount of that was building out fresh fiber network. You even said gold plated through connecting major cities, going through major markets. So you buy that for next to nothing, including the debt that you assumed. And if I heard you right, it was only burning a couple million a year. So basically, the transaction handed you over this gigantic set of fiber assets, freshly built fiber assets, where you really didn't have to pay hardly anything to get it. It wasn't like you had to go, in our case of ICG, we didn't pay that much, but we were stepping into what looked like a big burn rate that would have, on paper, meant we would have had to invest a lot more. So you weren't stepping into that situation. Wow. I wish those kind of deals were out there today for the taking.
It was unbelievable. And not only that, but it's the way we structured the deal. So it was, and we took it through bankruptcy.
Was there a period when you were bidding where you were asking yourselves, are we missing something here? What are we missing? Why is the next best bid negative 40 million?
Yeah, I mean, there wasn't, because it was so strategic to what Cavalier needed. I mean, we just could look at kind of the cost that we could take out of Cavalier's business by owning this fiber, where it just, it made sense.
So you were a strategic buyer at that point. So that may be what I was missing in the equation. So the fact that you were able to take this on and it be a very low burn rate was in part, maybe in large part, because you had an existing operation you were folding this into.
Exactly.
Okay, gotcha.
Yep. But and I mean, it was ended up being a great transaction for the business. I mean, we kind of at that point then sort of spun all that fiber out into kind of this entity in Telefiber, I think the rest is history. There ended up.
What happened to Telefiber?
So we ended up selling the entire business to Paytech. So Paytech wanted to buy. We tried to split them out, but Paytech wanted both assets.
Yep.
So we
sold. And then Paytech ended up selling to Windstream, if I remember right.
Yeah.
So the assets
Windstream actually owns every single one of our CLECs. It's pretty funny. They own Foam Michigan Ovation because those got sold in the cloud, and they own New South FDN. So I think all of our CLECs are owned by Windstream.
Yeah, and I cover a lot of territory in the book Bandwidth, but I don't cover that territory. The companies that got brought together and ended up in Windstream and Unity, for the most part, I think with the exception of McLeod, I don't, cover those in this. There's so much that happened. There's only so much that can be covered. Yeah. But there is a collection of fiber assets that are, sitting somewhere between Windstream and Unity, which I guess are going to combine back together. Has that happened already, or is that in progress?
It's in progress. Yeah. I'm not sure it's happened yet. But,
so those two will find themselves back together, still with a lot of legacy business kind of, but within there, kind of a pretty decent concentration of fiber assets that are maybe super regional in nature. So, so that's kind of one more pocket of fiber assets that maybe still can be part of something bigger over time.
Yeah. Yep. Yeah. And so then my partner Brian did the Light Tower transaction. That was an interesting one where they had fiber and tower assets, and the team running that wanted to do a management buyout. And it's a very similar situation where, again, it was owned by a big utility. They had done a larger transaction. I think they sold it, and the buyer didn't want the fiber and tower assets. So we offered a solution with that team where we could kind of carve that asset out, and the buyer could have a clean utility. The interesting thing is, so we bought the fiber business. Basically, the price was bought the fiber like 6 times, and the towers at like 12. I forget what I think we paid like $225 million for it, and then less than a year later, we sold the towers for like 185 million, and then took that and invested in the fiber network. But had an option because I think National Grid was buying Keyspan. We had an option as part of that transaction to buy Keyspan for like five times EBITDA or something. So it was that ended up being a pretty interesting transaction. And then for the last one, well, we've got two more. We got one currently in the portfolio, but
And just to talk a little bit more about Light Tower, so that was how Light Tower really got started and launched. But then you brought Rob on. By the way, I caught up with Rob recently. His son is now, I think, a freshman at CU Boulder. So we caught up when his son was considering coming out here. Unfortunately, when they came to visit, I was out of town, but had one of my team members met with them and showed them around Boulder, and we got them introduced to some of the right people at CU Boulder. But Rob did just a great job running Light Tower. He was really the only CEO. He brought him in, and he was there all the way to the end. He ended up acquiring multiple other companies, and then sold to, I think they probably recapped along the way, and then eventually sold.
That was one of our regrets. We recapped to Berkshire Partners.
Yep.
And so our co-investor that was Pamlico, we didn't roll in that deal. We sold because we had Zayo, and we just basically sold out completely. And we wish we had rolled because I think they made another 3 to 4x on that roll. But after we recapped, I think as part of that recap, they bought Sedera, and then later on bought Fibertech.
Yep. But you guys did really well financially on that one as well. So if you had rolled, you would have doubled that again. And, I don't know what that total amount would have been, but then it might have been a multiple kind of similar.
It would have been similar to Zayo, yeah.
Similar to Zayo. But, and maybe even, similar time frame too, I would imagine. So, because on Zayo, you guys probably made, what'd you guys make on that? 14 times your money back or 13, somewhere in there?
14 and a half.
14 and a half times on a big check. I mean,
it was a big piece of funds. Yeah.
Yeah. So
we had a huge concentration in fiber. I think in MC6, I think fiber was close to 30% of the fund. It was a pretty big concentration with those two deals.
Well, you guys were buying at the right time. I mean, all of your counterparts were not buying in that era, right? I mean, you guys made multiple bets at a time when private equity venture was avoiding fiber as if it was, toxic. And you guys made multiple big, meaningful bets at a time when it wasn't popular, and it paid off huge.
Yeah, that was a good run. But in the last one, so Everstream was one we did in MC7. That was in 2015. But that was that Cleveland-based network. It was an interesting situation where it was owned by a nonprofit in Cleveland, and they had gotten about $80 million to fund the build-out across Northeast Ohio to connect hospitals, universities, and I think the issue with a lot of these fiber companies that got grants is they budgeted enough to build the network, but then actually didn't have enough to actually operate and grow the network. And so they ended up raising like a infrastructure bond from the Port Authority. And one of our actually the guy, Brett Lindsay, who we brought in to do Atlantic, we tried to get him to then run the fiber business at Cavalier. He wouldn't move from Cleveland. So we ended up then backing him at Everstream. He was at Everstream, came in, and basically he called and said, listen, I can't grow this business. I've got a bond that's due in 6 months. You got to come in and help. And so we talked to the board. It ended up being a bit of a longer process, but ended up buying that business at 50% on replacement cost. It was a pretty interesting buy there. And then just, kind of similar playbook, just built out the sales team. We then bought another company in Michigan, which was a very similar story to ICG, where nice network, great network, but the team was just launching all these different types of products that had nothing to do with the network. And so that was burning, I think it was $6 million of cash. That one went into bankruptcy. We actually we thought Light Tower and Zayo were going to pick that one off in bankruptcy. So we were, didn't know if we should engage or not. We ended up engaging and basically bought the business for 7 times EBITDA. When we took the cost out, and then bought a third asset, in Michigan. So kind of took a took a business of about, I think it was, 10 of revenue and $1 million of EBITDA when we got in. We sold it. It was doing about 50 and I think about 18 of EBITDA. So it was a good run there. But that's where we started seeing these infrastructure funds come in. And I think that was one of the first fiber networks sold to an infrastructure fund, where, these funds, they just have a different cost of capital. And so, the multiple that we sold that business for, we were only, I think we were less than 3 years into that deal. And I remember Brett saying, "Hey, I could sell this thing for, $275 million," which made no sense to me, right? But we had a process, and we ended up getting $333 million for it. And the multiple, I think, was at that point was the high watermark at that point. It was like 22 times.
Yep.
But
wish we showed Zayo for 22 times.
yeah, that was nice.
That would have been the scene instead of, we invested about $1 billion in total, and when we sold, that was worth about $8.5 billion. But that would at least have doubled the $8.5 billion, maybe even tripled it. So yeah, we would have. That would have been nice. We'll get to this part later. I want to talk about what happened when the infrastructure funds started to come in to the space, because that's part of what changed the dynamic and hit that high water mark. But let's go back and let's zero in on the period of time that was 2011-ish. We raised the Series B, as we talked about earlier, in 2009. We continued to do various different acquisitions. Things were going really well for us. And, now we're running through our Series B facility, and we're faced with the decision: do we exit, either in the form of selling to a strategic, perhaps, or there wasn't really an option at that point to sell in the form of a recap of that nature. Would have been if we had waited another year or two. I think that's when, well, actually, we'll get to that because I think those two are kind of interrelated. So we could have gone public, or we could raise a Series C. And, we were all grappling with what the best thing to do was, and we ended up, figuring our way toward a Series C route and turning our sights toward above net. Any memories you have of that period of, what's the best option to do? And then as we, zoned in on first 360 networks, which was a big deal for us at the times, then immediately thereafter, kind of setting our sights on above net. I'm sorry, I got that mixed up. 360 was after that, but the whole above net situation.
Yeah,
any memories that you have?
I have vivid memories because as you mentioned, people not understanding kind of the fiber opportunity and the value of these networks around that period of time, and we didn't have a ton of liquidity in 6, and got a lot of questions like, listen, you've got a lot of concentration in fiber, is this going to work out, right? And I think we had an offer because this is before we sold Light Tower, and we sold Light Tower in 2013. But it was like 3.5x, I think, is what it equated to with that one offer that came through. And it was like, for a split second, we were debating, but at the same time,
wait for a second, just so that the people listening can follow. When you said you had an offer for 3.5x, we were talking about Light Tower and 3.5x meaning
for Zayo. For Zayo, you remember it was there was an opportunity to. It was a firm that offered us that price to get.
I don't remember.
Yeah,
what am I forgetting?
It was. I think it was. Wasn't it Silver Lake?
Oh yeah. We were working with Silverlink as an alternative to an IPO. I think that was on the 2011, 2000 time frame. But anyways, it was one of the things where, like, we just saw the opportunity. We saw just how big this could actually get, and it just because we held Zayo for, gosh, what was it, 8 years? 8 to 9 years. So. By today's standards, that's a short investment cycle. By the standards of 15 years ago, that was kind of a lengthy investment cycle.
Yeah,
a whole different topic.
but yeah, no. So I remember from that perspective, it's just sort of the I wouldn't call it it was the questions around when liquidity would happen in the fund, and those kind of dynamics. But then also seeing just this massive value creation opportunity, and riding it out in the face of that. That was, and obviously happy we did.
Yeah, the craziest thing with as I was refreshing my memory going through the research for the book and honing in on AboveNet was, AboveNet was doing so well. I mean, they're a public company. They doubled their stock price. So the stock price is doing really well. But you look at it and it was trading at maybe 9 times EBITDA, maybe 10 times. And even as they were running it through processes, the would-be buyers who were very interested in a property were being stubborn about a price that was, in the 10 times EBITDA, vicinity. They didn't want to go higher than that, even though it was many bidders were showing interest. And you look at that through, and we all knew that the nature of the assets that AboveNet had were incredible. These were not thinly built fiber networks spun off from a utility. These were kind of in the major cities, connecting the major data centers with significant amounts of owned fiber across most of the key markets in the US. Yet the valuation credit they were being given in the public markets was, ridiculously low, even by the standards of that era. I mean, the private companies were getting, 4 turns more than that for far less performing assets and far less quality assets. So our good fortune of being able to figure out, our capital structures so that we could have access to the kind of money to do that deal. But the fact that others weren't willing to step up to that price is pretty amazing when you look back on that today. I mean, there's no reason that asset should even have been available for us. By the time we got our money together, and if it was available, the market should have forced us to pay a higher price, and it just didn't. And that's not a reflection on the people who were selling it. That's just the market condition, and other investors weren't willing to bid it up.
Mm-hmm. Yeah, no, I totally agree. It was a premier asset.
Yeah, no, it's great. And Bill did a podcast as well, which is a really fascinating one. And the other thing I guess I kind of realized at the time, but I realized it even more as I did the research. What he did as CEO in that company, how much he accomplished, how much value he created was pretty amazing. He came in when right after the bankruptcies when he was named CEO, and if you look at the value that was ascribed to the value when he started versus when he sold, gigantic value creation. To his credit.
He did a great job.
Very good. So then we go public, and you were there in the room on the day we were pricing with the markets in just horrendous condition. Any memories from?
You just start from the beginning. I mean, those 2 weeks that we launched. I mean, I can't believe we launched into like. I remember sitting down. There's a journal article like the day after we went public where it says like markets faces its worst decline in like 2 decades. I think it dropped like 2,000 or 3,000 points while you guys were on the road. I think like was it like the Syrian strike, it was Ebola outbreak. It was, I mean, event after event was hitting the news. But yeah, that was a pretty tense time of deciding whether to go or not and push the button. I think we ended up reducing the size, how much we sold. But I think in the end it was the best thing for the company. So,
any specific memories from that last hour or two when we were all together in the room at, was it Morgan Stanley, and we're trying to make sense of what to do at that point, given the market conditions were a huge, headwind that we were facing. The book was light, and what I mean by that, when I say book is light, the way these processes work when you're going through an IPO is the book means kind of orders, institutional investors in particular, expressing interest in buying your stock and tying that to the price that they're willing to pay. And obviously the more interest there is and the higher the price of the interest allows you to, sell your shares at a increasingly higher price. So if you have a really strong order book, that means that the investors are really interested in buying. and it makes for a really good IPO. If you have a weak order book, you're faced with the dilemma. What do? Do you sell less than you want to sell? Do you sell at a lower price, or do you not sell at all? So we're kind of staring at that and saying, okay, this is a really tough environment. We've gone through the full roadshow. Now we're sitting in the room trying to make sense of this all. Any memories from?
Yeah, it was. I mean, it was. I was a little torn because it was obviously. I mean, I think the conditions and just everything that led to that pricing was not ideal. And I think we were getting basically, the market was. We were selling at a much lower price than we, one, thought the company was valued at, but two, had expected. But at the same time, wanted to be supportive, and so I think it was really. I remember some of those conversations. Just how much should we sell, and should we sell, and there being a lot of debate around that. I think there's a lot of differing views with the existing investors. I'm not sure. Did one of them not actually sell? I don't know. There was some question around that, but
yeah, there was one who I won't call out. One who just said they don't really care what the rest of us do, but they're not selling at that price, and they weren't one of our lead investors. They were one of the other investors. But what was ironic about that is they did so well on that investment, even though they were not one of the kind of lead investors. So you think at a bare minimum they would have deferred to the other investors who brought them in the deal, or to the management team who helped make their investment many X in the multiple. But their response was they really didn't care what we thought. They they weren't going to sell at that price, and we could do what we want. They didn't really care. So, and in hindsight, as a CEO, you kind of go through this once, usually, maybe twice. Rarely does a CEO go through this 3 or 4 or 5 times. As investors, you go through it, but probably not that often either. But you go through it. At this point, you've probably been through it a number of times, but the investors who are in a room on a deal, unless they're some big Silicon Valley firm, they're probably doing this, infrequently. The bankers obviously do this for a living. They do it all the time. So you don't really know what's happening when you're going through it. You can't fully prepare yourself if it's the first time you're going through it. So, when a curveball is thrown like this at us, it's not like you know what the playbook is. Okay, here's how to react. As I look back at it and just put in full perspective how little we were selling of the company, did it really matter if it was $18 or $20 a share or $17? It mattered certainly mattered at the time. It was very emotional at the time, and there was a huge question of hey, if the price is only 18, we're not going to sell. If it's only 17, we're not going to sell. But then you do the math, and it's like, okay, what a bad decision that would have been if we would have pulled out over $2 or $3 a share.
Yeah, no, and that's exactly what we kind of ended up was. I mean, we ended up selling a pretty small piece of the overall position, but got the company public. I think unfortunately the float was smaller, right? Was lower, and so that did lend itself to some disruption when we did some secondaries. If you remember those days, but
we won't talk about the first secondary where people could sell on their own. And
telling someone around the office about that one. I think I was like driving into work on a conference call with Ken, and I won't name the investor, but like, oh yeah, we just sold last night, and then it just was open season. Everyone was selling. So, but
and to put in perspective for people listening in, so we're having one of our first earnings calls. So maybe this is our second earnings call, and let's say it's a Friday morning or whatever day the earnings call would have been on. The days leading up to the earnings call, the investor group and the management team was discussing how to give investors the ability to sell their shares in the open markets earlier than what was otherwise planned. Usually when you do an IPO, there's a period of time where investors, management can't sell their shares in the open market, or they can only sell a small portion, or you do a coordinated sale where you sell, but you sell as a group. But eventually you get to a point where everyone has their own shares and they could sell when and if and how much that they want. So before that period of time played out where that would have naturally happened, we got together a group and said, okay, is everyone comfortable giving the group more freedom to sell in advance of that? The stock was trading well, the company was doing well, that very natural conversation to have. So as we're working our way toward the earnings release and the earnings call, we reached an agreement to allow that to happen. So I get on the earnings call, and it was a good quarter. We did what we said we were going to do. It was positive news. I was feeling good about it. Yet people are flashing in front of me like our stock price is dropping. Dropped $1, dropped $2, dropped $3. Like, why is their stock price dropping? We're trying to figure out what is it that either I said or that we shared that's being reacted to negatively. The market wasn't going down. Well, we find out about halfway through the earnings call that one of our investors, as soon as we said, yes, we'll give people the right to sell, that night before the earnings call, they distributed all of their shares to their investors. And the investors, as soon as they got the ability to sell, just hit the sell button. They didn't know what was going on in Zayo. And that's just a rule that a lot of institutional investors have. Hey, as soon as you have the ability to sell as quickly as you can, because there's going to be a sales, flurry of activity that typically will drive the stock price down. And it's like, really? You caught us by surprise during the earnings call. Maybe we should have been more thoughtful and not let that happen the night before the earnings call. But I don't think that was as much of a thing back then as it is now. The ability to distribute your shares to your LPs and have your LPs sell. I think that was relatively a newer kind of dynamic in funds. I think since then it's pretty commonplace.
Yeah, I think you always had the ability, but I think people would sell stock for the LPs. But yeah,
gotcha.
Yeah.
But it was pretty crazy. There was a lot of crazy stories. And you learn a lot in the process. You got to go through the journey. Yeah. So, and you guys, how long did you hold on to your Zayo shares after the IPO? What was your
we sold so the fund sold their last share in 16.
So over a couple year period, you kind of did a steady exit.
Yeah, but I took all my shares and I held them until sold to 20. So
good deal.
Which was took some intestinal fortitude, because when it the stock dropped to what was the low point? Was it like 12? I was like, what have I done here?
We never went down to 12. I think you might be thinking when it went from like low 30s to like 24.
No, in 2018. Remember that period of time and when the whole market crashed? Like it went down. It rebounded quickly, but it went down to like, I think it was like 12 or 13.
Did it really?
Yeah.
I'm gonna have to go look back. I never remember being below our offering price. I thought we were always in the 20s or 30s.
No, it was that market crash, and I don't know what caused the crash, and it was December of 18.
Really?
Yeah.
Wow. I can't believe I don't remember that. You think that would be like...
held on, and I finally got out at 35, so it was all good.
Yeah. So what, from your vantage point, when Zayo was going through the crazy sales process, which you weren't involved with the company then, so you were on the outside looking in, but could you tell what was happening with the two groups that were trying to buy the company?
I didn't.
Was that transparent, or was it really murky?
No, it was pretty murky. I was actually reading the book. It was actually I didn't know a lot of those details, so it was. I mean, I knew who was involved, the two different parties, but didn't realize the dynamics that were going on and everything that was happening there. So that was that must have been tough to go through. That was.
Yeah, what's kind of interesting is when public company transactions happen, as you well know, Gillis, the documentation of exactly and precisely what happened is required to be produced in SEC documents. So I was able to take those documents, especially if you if you generally know what was going on, so you knew who the players were, because there's a little coding that's used in these documents. But if you know the decoding of that, and you kind of were part of it, so you could kind of, if there's any gaps, you could connect the dots. But most of the detail is, printed in a document that's been filed with, scrutiny by attorneys and otherwise. So it's not, based on memories of, what happened. That, memories could be such that one person sees it one way, another sees it another way, and you can recreate a story. But in the case of both the AboveNet story, which was a very fascinating kind of takeover situation, and then the Zayo transaction, to be able to retell those stories with the backing of these SEC filings makes for very good storytelling, and hopefully a lot of people are able to learn from those as they're getting ready to go through their processes, either as a buyer or a seller. But it's also very entertaining when you read them and reflect on them.
Yeah.
So, but pretty crazy. I mean, that was, that's also one where a lot of the decisions of to do the deal or not to deal came down to $2 or $3 a share, which in overall scheme of things you could look and say that's immaterial to whether you would want to do a deal or not want to do a deal. It wasn't like these were bid up assets that were a result of a auction process where the price got so high that someone didn't want to pay that last $2, so the other one won. It was a certain level of stubbornness, not unlike how we benefited from when we bought AboveNet. The counter bidder just set a price and didn't want to go higher it, and they missed out on the big picture by being stubborn over a handful of dollars a share on a property that was, in that case, certainly worth a lot more than we bought it from. The Zayo one, I think, time will tell how the transaction works out. Certainly, there's work to be done there still, but it's such a unique and powerful set of assets, and the need for bandwidth isn't going away, and the utility of fiber is not going to go away. So my guess is the new investor group ends up doing quite well on it as well. And as part of that, having a very passive role as an investor there, I hope that proves to be the case. But it was a fascinating process, no doubt. The whole journey was.
Yeah.
So what are your personal big aspirations as you look forward in your career? You're still got, your best years in front of you in terms of all the wisdom you built up as an investor. What is it that, as you look forward, you think about the most?
Yeah, no, it's really, kind of continuing to build the firm here. And I think, we've been around for, a long time, and there's been, kind of multiple evolutions. I think, right now we've got a very clear direction.
Who are the key principals on the leadership team at this point?
So it's myself, Brian, Travis. I don't know if you've ever met Travis. Was at Altman.
Okay.
We've known him for forever.
I probably knew him in the Altman context. In fact, I got to reach out to Altman because they were a big part of a lot of these diligences of all these deals that were taking place, and doing consulting work in the industry. I bet you they'll get a kick out of reflecting on the story.
Definitely. And then Jim is our chairman. So he's between Fund 8 and Fund 9, he moved into that role. So it's kind of the four of us.
And Jim is Jim Wade, who was running the firm when we did both ICG and MC. So he was certainly active in those two deals. It was Peter taking the lead in ICG, you taking the lead in Zayo. So he wasn't front and center. He wasn't at board meetings, but I'm sure he was, played a very active role in kind of enabling the deals to happen, supporting the deals, and and being a great partner as well.
Huge supporter of you. He founded the firm back in '86, so he was at TA Associates. Founded in '86, did a number of all of our wireless deals. Obviously, he did one of the more interesting deals. It was Metro PCS. Talk about having a vision for a business. Doing a raw startup. So Metro PCS with the licenses, they were coming out of bankruptcy, and in 2000, basically deciding to build that business model from scratch, and launch that business. And So that ended up being a very, very successful deal for the fund. That was the four of us. And really, yeah, I think what we do in terms of partnering with founders and really helping to build businesses, that's a model that it's challenging to scale that to a multi-billion-dollar fund. But I think we have room to grow. Beyond, like, our last fund was 350. I think growing that in a modest pace over time. But just sticking to our knitting and focus. That is probably, as I look around the industry, one of the hardest things to do today is keeping focus and understanding kind of your mandate, what's the right deal for you as a firm in terms of your strategy and the value proposition that you've sold to your LPs. Because as we look at kind of some of our core segments like fiber, we're going to buy a fiber business at 20 plus times. No, the fiber to the home sector, that's gotten crazy. So I think discipline and maintaining that, and just knowing exactly what we're going to invest in, what the business model is, what the intrinsic value of those models are, and making sure we're taking execution risk, not valuation risk. And that I think is something that just continuing to kind of align around that, and grow the firm over time.
Yeah, and part of the theme of the book Bandwidth is that boom bust cycles repeat themselves. They have for decades and centuries in the past, and they will happen again in the future. That's pretty much a given. When and what the triggers are is less clear. I think when you look at what's going on in AI right now, and AI is a real thing, just like the internet was a real thing. AI, what's going on in AI in the last year or two is going to be every bit as transformational as any optimist has described, and then some. It'd be kind of like describing the internet in the early days and saying the internet's going to change everything. And despite the fact that we went through this big boom and bust cycle, the internet did change everything. And this Gen AI is, with 100% certainty, in my opinion, is going to have as profound of an effect. But that's one of the ingredients to a boom bust cycle. One of the ingredients is the cause of the boom was something that was so powerful and became so obvious that everyone wants to participate. I think another aspect of a boom cycle is it's not one thing, it's multiple things that converge upon each other, because that's what produces the unpredictability of the outcome. So in the case of the internet, it was fiber, it was mobile phones, it was deregulation, it was all this happening together and feeding off each other. In the case of AI, you could look at the interplay it plays with autonomous robotics, kind of vehicles and devices. You could genetic is going to play a role in that as well. And then before too long, quantum will feed that even more. So I think it's a fairly safe bet that when we're talking about the next meltdown cycle, it's going to be sometime in the aftermath of what's already begun. But it's probably not. We're probably nowhere close to the edge of that. We're in the build-up phase. So I like to think of, if I was put on my crystal ball, I would say this is kind of like 1997 or 1998, so 3-4 years before the big bust hit in 2001, and even a couple years before the gold rush really kicked into full gear. So we're almost right in the beginning of the gold rush, given this AI cycle, but some period of time measured in years, but maybe low single digit years from when there might be a correction cycle. And given like all the value that there was to be created in the last correction cycle, you toy with how do you balance wanting to have liquidity when that happens with not missing out on this big boom cycle that we're in at the same time. So it's going to be maybe more fun to watch this one play out because I'll have a lot less at stake.
Yeah.
But I think it will play out again.
It is interesting. We've because it is very similar. When I first joined MC in '99, you had these very large buyout funds doing startup CLECs, right? And it's just these investors that typically weren't investing in these businesses were coming into these sectors, and you're starting to see that. You have been seeing that over the last couple of years here. I think there's a couple of things that are different, and obviously the pace of innovation and the adoption of technology is so much faster than it was.
Yes.
You've got that going for you. And then when you look at who's funding this build out, for the most part, it's very well capitalized, investment grade businesses, right? It wasn't like anything about level 3 and others that were just cash flow negative, raising debt, So the disruption, I think, is not going to have as much of a ripple effect. There will be disruption. I don't think it's going to be the massive ripple effect you saw at the internet meltdown, just because I think it's just given how these businesses are capitalized. But what does concern me is just on the data center side is anytime there is such a lead time between demand and supply, you're going to get it wrong, right? And so if you get it wrong on the upside, then it's great. But you get it wrong and you overestimate power demand, that's where you're going to have some massive disruption. Because just the initial requirements to build some of these data center complexes. I mean, I've heard the big hyperscalers are requiring now 400 megawatt expansion capacity, right? I mean, that's close to a $5 billion complex when it's all said and done. It's not like you can grow into it, but you've got to make commitments to those utilities to get that power. So that's where we're a little more cautious. I mean, obviously that's a end of the market we're not going to play in, just given the scale. I mean, there are facilities that we're looking at that are, that make more sense for us. But I do think, well, put it this way, for a fact, people are going to get the projections on power wrong, right? It's a question of whether we're betting that it's too low or too high, and so, but there's going to be some significant disruption if the power requirements aren't as high. Obviously, just given all the investment that's being made right now.
And this is related to getting the power wrong. There's a couple other dimensions to getting the power wrong. One is investing in the wrong source of power, right? Mm-hmm. So right now, a lot of people are talking about nuclear as an example, but nuclear is huge investments. And I listened to a podcast just yesterday where some of what the activity around nuclear is not fully thought through in terms of where the underlying rare mineral that's needed for the type that they're talking about building. It's like that really doesn't exist on Earth. It exists on the moon, but now you're talking about getting a bunch of this rare minerals from the moon to the Earth to power these nuclear facilities. Has people really thought through that? So are you going to get the type of power right? And then and this one again, this is one where I let my mind wander a little bit and question whether the extrapolation of what is happening right now is the straight line extrapolation really going to play out. And in this case, what I mean is there's gigantic power requirements at these extremely large data center environments that are being located close to the power grid environments. And so the extrapolation is, while you think that's a lot of data processing that's needed now at those sites, it's going to grow tenfold and then tenfold again. That's the way pretty much everyone's thinking about it, that all of this AI, Gen AI, right, GPU stuff's going to happen in these extraordinary data centers. So there's maybe two questions, like, are there going to be breakthroughs where the Gen AI can happen that doesn't continue to require a dynamic where there's so much processing power that has to happen? Okay, I haven't heard anyone talk about that, so the answer might be no, or the answer might be, maybe even that's where quantum computing comes into play, that you could start doing this massive, grappling of data to make sense of it without it being the power needs being so concentrated. And let's face it, we as human beings do an awful lot of processing ourselves. That sounds a lot like Gen AI, and we don't have big power plants attached to us. We do it in the confines of our bodies that don't really generate that much or require that much energy. So is there something that's going to make that be able to happen in a foreseeable future, way before all this power is needed? And then the second thing, which we kind of touched on area, is is it going to be in such a concentrated geography in which this processing happens, or does it happen over a much broader network over time? And hence, the need for kind of so much concentrated power in a relatively small number of locations kind of sort of progress to the point like, we still need that, but not at the growth rate that we thought, because it's happening geographically elsewhere in a more distributed fashion. So I think there's a risk. Again, the problem with the internet wasn't that we were wrong about the internet. The problem is, when all these trends started feeding off each other, it played out in very unpredictable ways. And I guess we could end this with one other thing that I think is an ingredient of a boom bust cycle, and that is most people, even the ones who are closest to the situation, think this one's different than the past ones, that this one's different in a way that it really isn't going to create a bust cycle afterwards. Somehow it's going to be smoother. Somehow it's going to stay more in sync. Yeah, there'll be some losers, but there'll be winners. There's something different this time, so that boom bust is going to repeat itself. You need most people to be thinking that way, or you'll never have a boom bust cycle. So the not just unpredictability of when it's going to happen, but the skepticism that it's even going to happen at all, ironically, is a necessary agreement for it to happen. I mean, it will happen, but it's a necessary agreement for it to happen. If it isn't for that, it'll never build up to a point where you have kind of such a big event. Yeah. So we'll see over time. Certainly not going to happen next year or two in any meaningful way. Well, good. This has been fun. I'm glad for those of you still listening, this is our second go at this one, because we had some technical difficulties the first one, and I'm glad we did the second time, because I think this one we touched on a lot of ground that was interesting. We got to focus more on MC Ventures and kind of what you guys are doing, and a little bit more forward-looking stuff. So I'm glad we did a retake on this one.
Yeah, no, this is great, Dan. Appreciate the opportunity, and congrats on the book.
All right, man.
Great read. All right.
We'll talk to you soon.
Thanks, bye.
Thank you for listening to this episode of The Bear Roars. If you enjoyed the episode, please like and subscribe on your listening platform. This podcast was produced by Loud Bear Productions and edited by Courtney Caruso with support from Kendall Weinberg, Emily Reed, and Gibson Siegert.